Hi, everyone. I'm Suraj Randhawa. I'm a Canadian CPA and the founder of SRPC. I work with small business owners across Canada to make accounting, tax, and bookkeeping simpler and a lot less intimidating. In this video, I'm answering real questions I get from entrepreneurs every day. Courtney from Kelowna asks, when is the best time to incorporate my business? And that's a great question, Courtney. The best time to incorporate usually isn't based on revenue. It's based on how much money you're leaving in the business. If your business is making more than you personally need to cover your lifestyle, incorporation can make sense because you take advantage of lower corporate tax rates and the opportunity to defer personal tax. If you're pulling out most or all of your profits to live on, incorporation often doesn't provide much benefit yet and can actually add extra costs. Kevin from Calgary asks, does incorporating actually reduce my taxes? And Kevin, incorporating doesn't automatically reduce your taxes, it changes how and when you pay them. Corporations are taxed at lower rates, but once money comes out personally, personal taxes still apply. The real benefit is flexibility and tax deferral. If you can leave money in the corporation to reinvest or smooth income, incorporation can be powerful. If not, the tax savings might be smaller than people expect. Amanda from Edmonton asks, what is a fiscal year end and can I choose it? And yes, Amanda, corporations can usually choose their fiscal year end, and that flexibility can be useful. Your fiscal year end determines when income is taxed and when filings are due. Many business owners choose a year end that lines up with slower cash flow periods and less busy times. Sole proprietors don't get this option. They're locked into December 31st. So, this is one of the quieter benefits of incorporating. Ryan from Calgary asks, salary or dividends? Which is better? And Ryan, this is one of the most common questions I get. Salary gives you CPP contribution and RRSP room, while dividends don't. Dividends are simpler and can sometimes be more tax efficient. And for many business owners, the best answer is actually a mix of both over time. The right choice depends on cash flow, personal income needs, benefits, and long term planning. Melissa from Edmonton asks, what's the difference between a T1 and a T2? And Melissa, a T1 is your personal tax return, and a T2 is a corporate tax return. If you're a sole proprietor, your business income flows through your T1. Once you incorporate, the corporation files its own T2, and you personally file a T1 for what you take out. It's a big shift in how the CRA looks at your business. James from Vernon asks, what exactly is a T2125? And James, the T2125 is officially called the Statement of Business or Professional Activities. It's a form sole proprietors use to report business income and expenses as part of their personal tax return. This is where revenue, expenses, vehicle costs, home office claims, and other deductions are reported. If you're self employed and not incorporated, this form is the backbone of how the CRA calculates tax on your business income. Sarah from Kelowna asks, what does write off actually mean? And that's a great question, Sarah. A write off is a simple, legitimate business expense that reduces your taxable income. That means you're paying tax on a smaller profit amount. The tax benefit depends on your tax rate. It's not dollar for dollar refund, but it does reduce how much tax you owe overall. The goal is to claim expenses that genuinely support your business. Mark from Calgary asks, what types of expenses tend to raise red flags with the CRA? And Mark, the CRA tends to pay closer attention to expenses that could be personal in nature. Things like vehicles, meals, travel, and home office claims. It's not that these expenses are automatically a problem, but they need to be reasonable and well documented. Clean records and consistency go a long way here. Priya from Edmonton asks, when do I actually need to register for GST? And Priya, most businesses need to register for GST once they exceed 30,000 in revenue over a rolling 12-month period. That's revenue, not profit. Some businesses do choose to register earlier to claim GST credits. But once you cross that threshold, registration isn't optional. Missing this is one of the most common mistakes I see. Alex from Vernon asks, what's the difference between PST and GST? And Alex, GST is a federal tax managed by the CRA, while PST is provincial, and rules do vary by province. For example, Alberta doesn't have a PST, but BC does, which surprises a lot of Alberta businesses selling or operating in BC. Think of it this way: GST is about what you sell, PST is about where and how you sell it. Mixing them up can create compliance issues. And if you found this video helpful, please like and subscribe and drop your own questions into the comments. I use those questions to help shape future videos. And if you need personalized help, you can find me at srpcaccounting.com. And thank you for watching.